Welcome to our show, everybody. Today we're talking to those of you that are about to sell a house, have sold a house, or find yourself with a whole lot of equity in your house, and you're like, hey, if I sell it, I got to pay potentially capital gains, so we're going to go over that.
Yeah, anybody who has bought a house between probably about 2009 until now, your home has appreciated, and the real problem is the brackets of how much you can take has not changed since, like 97, forever. I think.
Yeah.
So it's been a long time since they've actually changed anything.
It's like that income that you make on Social Security. You know, they're like, before it becomes taxable at various levels, they never change that number.
Yeah.
So it's all, we're all getting taxed on it. Anyway, that's a side topic. We're not going to go there. If you have a house and you're married filing jointly, and you make over $500,000, I should say if it's your primary residence, right?
Yeah.
So you
got to
have
be
to
there
live
2 years.
2 years. The cool part, was it 24 months? They don't have to be consecutive. So within a 60-month window, you just have to have been there for 24 months. Mm-hmm. So we're saying primary residence here. This is not a rental or a short-term thing. Married filing jointly, $500,000. Anything over that, well, you're going to owe capital gains taxes. Single, it's $250,000. And I find myself in this position, getting ready to sell my house because I know my insurance is going to drop me. So I'm just going to sell it. So what do? How do we lower the taxes on that? If it was a rental, it's a little bit different, right? Because it's sort of like a business, right? So you have a different tax game you're playing over there. You've also got depreciation and everything. This is just, I'm living in a house. I'm lucky. I made $600,000, $700,000, $800,000. Crap, I got to pay taxes on that. What do we do?
Single filer is going to be the real predicament for a lot of people. I mean, $500,000 married filing jointly. I mean, your house has had to appreciate a lot, which, again, if you bought in 2012 and you're selling in 2024, there's some great opportunity here. Yep. But a single filer, you're talking $250,000. Really, if you bought 2012, a $250,000 house, I could put money on almost every situation in most areas, especially where we're at. I mean, houses are now $600,000-$700,000. What were $250,000 then?
I was just talking with
all
a friend.
Day long.
We were at the Clearwater office and I was talking to a friend who was like, "Remember when those houses right around our school were like $88,000?" And we thought, "Oh my God, that's so much money." And that's a $700,000 house now. Like he lives there. That's just incredible.
So before we get into this, I know there's probably somebody that's like, "Oh, well, he said 24 months." And there are some hacks around this because I actually had to do that because I'd built a house and sold it it was about a year and 8 months. And I wasn't in the full 24 months. But working with my CPA, I was able to actually find out some things where if you're moving to relocate for work and it's more than 50 miles distance, then I could prorate that $500,000 gain there. And so there was some opportunity there that we were able to work off of. And so it's really just knowing these little rules and nuances when it comes to this, because you can create some good opportunity and not just sit there and say, "Oh, I'm going to have to pay it all in."
Yeah, it's not all or nothing in that case.
Yep.
Wow, I love it. Well, so what do we do? How do we reduce the tax there? That's going to be the common question. I've gotten the question quite a bit, and now I find myself in the same position. So how do I lower my taxes?
Yeah, well, I mean, you got to ask yourself, have you done any improvements and not, changing the faucet? It's like, the faucet leaked. I called Bob the plumber and fixed that. It's have you done any major improvements to your house? A lot of people in Florida have put in a pool. Well, that's going to increase the value, but that was a big expense. That has to add to the cost basis that you're talking through here on your home. So there's got to be things that any big improvements, that you're looking at.
Think about, so if it's a rental property, of course, the garbage disposal, all right, you can sort of deduct that, right? In a primary residence, the IRS is really specific to say you have to improve the value of your house or prolong the life of the house. So it would be those types of improvements. If I change the garbage disposal, I did not improve the value of the house. I didn't prolong the life of the house. I just fixed it. It's like it's a different thing. So, for example, you get a new roof. When the house that I bought, when we got it, it needed a new roof. We knew that going in. I'm keeping that receipt, right?
Yeah, 100%.
So that counts. It adds to the value there. The screen enclosures, things like that. If you get here, especially if you replace your windows, they gotta be hurricane rated and all that stuff. Okay, you've improved the value of the house. So you can say, "Oh, I spent, $500,000 on a house, but over at least the 24 months, man, I got a roof, I got a screen, I got windows, that's another 100,000, 150,000, 200,000. And then that way, maybe if your house sells, in this case, I guess I would say over $1 million, you're now deducting that off of what you're, and it's not a deduction, it's you're saying you raised your basis. So you paid 500, you got 100 more into it, your basis is 600. You put 50 more into it, now it's 650. And that's a really big help right there for major expenses.
Yep. Yeah, and thinking through your basis, understanding, making sure you understand the concept. You pay $250,000 for the house, that's your basis going in. And so then, from there, those improvements, $30,000 for the roof, now you're at $280,000. Trying to figure that out. Sometimes you're going to pay cash for some of these things too. And if you're paying cash, that's okay. You just need to make sure you're documenting, because what's going to happen is if you get an audit, you have to be able to prove to the IRS, hey, here's where this came from.
Yep.
So that's a tricky one. If you're not keeping up with every little thing that you're doing, or you're saying, hey, you know what? Bob the plumber said he'll come over here and replumb my whole house.
I need a receipt.
it's I'm going to pay him cash under the table and make this happen. So sometimes trying to cut corners can actually cost you if you get audited by the IRS and can't prove it.
Who could have seen it coming though? Like you have normal price movements of houses, and now it's like there's so much just in the last 4 years.
Everything is doubled. Where we're at specifically, housing market has doubled on the coast, Gulf of Mexico, over Clearwater area. It's just insane right now.
So let's think about this then. Somebody goes, I've got, all right, I paid $5 for the house. It's worth 1.3, right? So 5 of it is tax-free. Now I've got 300,000. Let's say you fall into the 15% bracket there. All right, 300 left over. We're using some of those improvements to raise our basis, right? And then what happens if we get down to like 100,000 left over, and we're like, I don't have anything else to use. So this is the year you fill up your 401k. It's what it is. Yeah. This is the year that you max out your HSA. This is the year you don't do conversions. This is the year you don't do backdoor Roth conversions. Like, think about it like that too. It's not just raising your basis. It's like, what other dollar moves can I make? Got a SEP IRA, and if you can afford to do it and get up to the 25%, okay, great. Think about it that way too.
Yeah. No, you've got your brackets on your long-term capital gains: 0, 15, 20.
Most people probably fall in 15.
Most people are going to fall in the 15% bracket. But you do have to be careful of that.
Nice.
All right, so if at first you don't succeed, maybe skydiving's not for you.
Stephen Wright. That's a Stephen Wright joke.
Is it?
Yeah.
Oh, I didn't know that.
Hey.
Reddit dad joke is where I get it.
Well done. Well done. Oh, you got to hear him say it, though, the way he just kind of like a bum. If it's a penny for your thoughts, but you have to put your 2 cents in, somebody's making a penny.
Somebody's making some money off of you. What about NASA's launching a satellite to say sorry to the aliens? It's called Apollo G.
That's more what I kind of expected out of you there.